You're finally ready to think seriously about buying a home. So you open an online mortgage calculator, you enter your household income, you enter your down payment, and within a few seconds, it gives you a number. Maybe it says you can afford $400,000, maybe $600,000. You speak with a lender, get pre-approved, and start looking at homes near the very top of that price range. But there's one major problem. The maximum mortgage a lender may approve and the mortgage you can comfortably afford are not always the same number. A lender is determining whether your application fits within its lending guidelines. The lender is not planning your grocery budget. It is not saving for your retirement. In this video, I'm going to show you how mortgage affordability is actually calculated in Ontario. We're going to look at households earning $60,000, $80,000, $100,000, and $150,000 a year. I'll show you approximately what each household could qualify to purchase. But more importantly, I'm going to show you how to decide whether that mortgage would actually fit into your life. Because qualifying for the home is only the beginning. You still need to be able to afford your life after the mortgage payment comes out. Hey, I'm Brian Hogben with Mission 35 Mortgages. Every day, my team helps Canadians purchase their first home, structure their mortgages, refinance debt, and create long-term financial strategies through real estate. And one of the most common questions we receive is, how much mortgage can I afford? But before answering that question, we need to separate two completely different numbers. The first is your qualification number. That is the approximate amount a lender may be prepared to approve based on your income, debts, credit, down payment, and the property you're purchasing. The second is your comfort number. That is the mortgage and total housing payment you can carry while still paying your other bills, saving money, enjoying your life. Sometimes those numbers are fairly close. Sometimes they're dramatically different. And when people confuse the qualification number with the comfort number, that is how they can end up house poor. They own the home, they make the payment, but there's almost nothing left for anything else. So let's begin with how a lender looks at your application. When you apply for a mortgage, the lender generally begins with your gross household income. Gross income means your income before deductions, before income tax, before CPP and EI, before pension contributions, before workplace benefits, and before any other deduction that comes off your paycheck. The lender then uses debt service calculations to compare that income with your housing expenses and your other debts. The first calculation is called your gross debt service ratio, or GDS. This looks at the cost of carrying the home in relation to your gross income. The calculation can include your qualifying mortgage payment, property taxes, heating costs, and a portion of your condominium fees when applicable. The second calculation is your total debt service ratio, or TDS. This includes the housing costs we just discussed, plus your other required debt payments. I can include a car loan, credit cards, a line of credit, student loans, personal loans, and other financial obligations. Under CMHC's published insured mortgage guidelines, the commonly referenced maximums are 39% to GDS and 44% for TDS. But those are qualification guidelines. They are not necessarily a recommendation for how much of your income you should personally spend on housing. There's also the mortgage stress test. You do not always qualify using only the interest rate that you will actually pay. In many cases, you need to qualify using the greater of your contract rate plus 2 points, or the minimum qualifying benchmark. So, for example, if your actual mortgage rate were 4.5%, your application would need to qualify using a rate of 6.5%. The reason this matters is that the qualifying payment used by the lender may be considerably higher than the payment you will initially make. Let's begin with a household earning $60,000 a year. That could be one person earning $60,000. It could be two people whose combined qualifying income is $60,000. That household has a gross monthly income of approximately $5,000 a month. Under the assumption in this video, that household might qualify to purchase a home for approximately $240,000. The minimum down payment would be approximately $12,000. Because the down payment is below 20%, mortgage default insurance would generally be required. That insurance protects the lender, not the buyer, and the premium is added to the mortgage balance. At our example interest rate of 4.5%, the estimated monthly mortgage payment would be approximately $1,330. Once we add estimated property taxes and heating, the basic monthly carrying cost would be approximately $1,670. But that is not the complete cost of owning the home. You will also have insurance, hydro, water, internet, maintenance, repairs, and potentially condo fees. So the actual amount leaving your bank account could be higher. Now, $240,000 may not give you many traditional detached home options in the GTA or Hamilton area. You may need to consider a condo, smaller community, a property that needs work, or a longer timeline. That does not mean buying is impossible. It means your home buying strategy needs to match the market and the numbers. Now, let's look at a household earning $80,000 a year. That household has a gross monthly income of approximately $6,667 a month. Using the same assumptions, that household may qualify to purchase a home of approximately $325,000 to $330,000. The minimum down payment will be approximately $16,400. The estimated monthly mortgage payment at our example rate would be approximately $1,800. After adding estimated property taxes and heating, the basic carrying cost would be approximately $2,200 per month. Again, we still need to account for insurance, additional utilities, maintenance, and any condo fees. Depending on the area, this purchase range could potentially provide access to an entry-level condo, a smaller home outside the GTA, or a property that needs renovations. Location makes an enormous difference. A $330,000 budget in one Ontario community may purchase a house in another community. That same budget may not purchase a one-bedroom condo. That is why the income question and the location question need to be considered together. Now, let's look at a household earning $100,000 a year. This could be one person earning $100,000. It could be a couple where one person earns $60,000 and the other one earns $40,000. That household has a gross monthly income of approximately $8,333. Under our assumptions, that household might qualify to purchase a home for approximately $410,000 to $415,000. The minimum down payment will be approximately $20,700. The estimated monthly mortgage payment will be approximately $2,260. After adding estimated property taxes and heating, the basic carrying cost would be $2,800 a month. That can look manageable when we only compare it with the household's gross income. But gross income is not what enters the household's bank account. Income tax, CPP, EI, pension deductions, workplace benefits may all come off first. The real question is how much money reaches the bank account and what expenses need to be paid from that amount. Imagine this household brings home $6,200 per month after its actual deductions. The basic housing cost is approximately $2,800. Now let's add $150 for home insurance, $250 for hydro, water, other utilities, and $200 per month towards maintenance and future repairs. The more realistic housing cost is now approximately $3,400 per month. That leaves $2,800 for everything else. Now, subtract a $600 car payment, $250 for car insurance, $300 for gas, other transportation, $800 for groceries and household necessities, $200 for phone and internet, and $400 towards savings. That leaves only $250. And we still have not included clothing, entertainment, gifts, vacations, children's, pet, medical, unexpected costs. The household may technically qualify for the mortgage, but there's almost no margin left in the monthly budget. That is the difference between being approved and being comfortable. Now, let's look at a household earning $150,000 a year. That household has a gross monthly income of $12,500. Using the assumption in this video, that household might qualify to purchase a home for approximately $630,000. Because the purchase price is above $500,000, the minimum down payment calculation changes. The minimum is generally 5% of the first $500,000 and then 10% on the amount above $500,000. On a purchase price of approximately $630,000, the minimum down payment would be $38,000. The estimated mortgage payment in our examples would be approximately $3,400 per month. Once we add in the property taxes, heating, the basic carrying cost would be $4,150 per month. Now, one household earning $150,000 may be able to carry that payment comfortably. Maybe they have no vehicle payments, no consumer debt, strong workplace pensions, a healthy emergency fund, and relatively low lifestyle expenses. Another household earning the exact same income may have 2 finance vehicles, 3 children, expensive childcare, student loans, credit card debt, no emergency savings, same household income, potentially similar lender approval, completely different real life affordability. This is why asking only what can I qualify for does not give you the complete answer. The better question is, what housing payment fits the life I'm trying to build? And to answer that, you need to start with your actual take-home income. Don't guess. Do not use a random percentage from the internet. Look at the deposits that have actually entered your bank account over the past 3 to 6 months. If your income varies, use a conservative average. If you earn commission, bonuses, or self-employed income, do not build your life around your best month. Start with the income you can reasonably expect to receive consistently. Then, write down what your life actually costs. Start with groceries, transportation, vehicle payments, insurance, childcare, debt payments, phone, internet, subscriptions, medical costs, pet expenses, entertainment, travel, savings, retirement contributions, and an amount for unexpected expenses. After you have accounted for those expenses, calculate how much is realistically available for housing. But remember that housing is not only the mortgage. Your true housing costs can include the mortgage payment, property taxes, home insurance, utilities, heating, condo fees, maintenance, and repairs. A house with a $2,000 mortgage does not necessarily cost only $2,000 per month. And a condo with a lower purchase price is not necessarily the more affordable option. Let's say one property has a mortgage payment of $2,000 and a condo fee of $250. Another property has a mortgage payment of $1,800, but a condo fee of $700. Second property has the lower mortgage payment, but it has the higher monthly cost. Condo fees also affect lender qualification because a portion of the fee is included in the debt service calculation. So never compare properties based on only the list price. Compare the complete monthly carrying cost. Debt can also dramatically change what you qualify for. Suppose 2 households each earn $100,000. The first household has no debt. Second household has a $700 a month car payment and required payments on a line of credit. The lender needs to include those payments in the total debt service calculation. Even though the households earn the same income, the second household may qualify for substantially less. This is why paying off the correct debt can sometimes improve purchasing power more than simply adding the same amount to the down payment. But do not blindly empty your savings to pay off debt. You still need money for the down payment, closing costs, and emergencies. The type of debt matters. The balance matters. The required monthly payment matters. And the lender's treatment of the debt matters. That calculation should be done before you start moving large amounts of money. Your down payment is also not the only cash you need. When you purchase a home, you may also need money for land transfer tax, legal fees, title insurance, a home inspection, property tax adjustments, moving expenses, and other closing costs. A general planning range for closing costs is approximately 1.5% to 4% of the purchase price. Although the actual amount depends on the property and the transaction, a general planning range for closing costs is approximately 1.5% to 3% of the purchase price. Although the actual amount depends on the property and the transaction. So if you have exactly $20,000 saved and need all $20,000 for the down payment, that does not necessarily mean you're ready to purchase. You also need enough money to complete the transaction, ideally still have an emergency reserve after closing. Because the first repair does not care that you just use all your savings to buy the house. Some eligible buyers might also have access to a 30-year amortization. Under the current rules, that may be available when the buyer is a first-time home buyer or is purchasing a new build, subject to the lender and insurer's requirements. A longer amortization can lower the required monthly payment. That may improve cash flow, but it can also increase the total interest paid over time because the mortgage is being repaid over a longer period. A 30-year amortization is not automatically good or bad. It's a tool. The question is whether that tool improves your overall strategy or simply encourages you to purchase more home than your budget can support. So, how much mortgage can you afford in Ontario? Under the example assumptions we use today, a household earning $60,000 may qualify for around $240,000. At $80,000 a household income, it may be around $325,000. At $100,000, it may be close to $410,000 to $415,000. And at $150,000, maybe around $600,000 to $630,000. These are qualification examples. They are not instructions telling you what to spend. Your real affordability depends on your take-home income, debts, down payment, property costs, lifestyle, savings, and future goals. Right mortgage is not necessarily the largest mortgage a lender is prepared to approve. It is the mortgage that allows you to build equity with long-term wealth without sacrificing your entire life. To understand what you may qualify for and compare it with a realistic household budget, use the link below to book a mortgage strategy call with our team. We'll review your income, debts, credit, down payment, monthly obligations, and home ownership goals. Then we can help you build a realistic plan based on your numbers, because buying a home should move your life forward. It should not leave you financially trapped. I'm Brian Hogben with Mission 35 Mortgages. Thanks for watching. Subscribe to the channel if you're interested in learning about buying your first home, understanding mortgages, reducing debt, and building long-term wealth through real estate. And we'll see you in the next video.